laptop so that the larger screen will give you the best meeting experience. For those of you who are joining us for the first time, let me quickly introduce who we are and what we do. Have you ever been to San Francisco? If so, you have probably seen the landmark Transamerica Tower, which was built by our parent company, Transamerica. If you are not familiar with Transamerica, you definitely know Bank of America, right? Bank of America used to be Bank of Italy, which was part of Transamerica. But in the 1950s, Transamerica founder A.P. Giannini separated the banking business from the investment and insurance businesses and changed the name to Bank of America. Transamerica Financial Advisors is an investment broker-dealer, and we provide investment consultation and retirement solutions in the United States. We are proud to be part of the Transamerica family and also proud that we are the #1 investment broker based on the number of female advisors. We also are World Financial Group, another part of the Transamerica family, which is an insurance broker-dealer based in Atlanta, Georgia. WFG works with more than 70 insurance companies to provide a wide array of life insurance and income protection solutions. Now, World Financial Group offers an entrepreneurship program for individuals and teams to build up their own companies with strong back-end support. Just like Amazon provides a platform for many small business owners to sell their products, WFG provides a platform for business owners to build their own independent marketing teams. Our team is Everest, one of the top companies on the platform, with more than 1,000 licensed associates across all 50 states. Our licensed professionals are from all walks of life, such as engineering, accounting, education, and management. We open new offices every year in different states, and new technologies such as Zoom allow us to work remotely, but stay closer than ever with our clients and associates. What is our role in the financial industry? We are a bridge between the client's needs and the financial solutions to those needs. We represent around 200 of the most reputable insurance and investment firms, offering a one-stop shopping experience for our clients. We focus on financial education, and we represent our clients' best interests to find the most suitable solutions for them. Tonight, as part of our education series, we will be talking about in IUL, that's Index Universal Life Insurance, and we will be doing a deep dive into that topic. And now, it is my great honor to introduce our first speaker for tonight. 15 years ago, Johnny Q took some time away from his IT consultant job to join WFG part-time. Like many of us, Johnny started with little knowledge of financial products and being unsure of his communication and sales skills. But a decade later, he was a financial product expert and one of the top producers for Team Everest. Now Johnny is focusing on building his team Evolve, and he has more than 6 offices across the country. Personally, Johnny has been an inspiration and a mentor to me, always able to provide reliable advice on both products and techniques. I look forward to his training tonight and hope that we can all pay attention and learn something new about our industry. So now please help me welcome Johnny Q.
Thank you so much, Aaron. Wow, you're really professional MC, awesome. Good evening, everyone. Okay, so Johnny here. If you are the first time joining our meeting, today you can see we have some friends. With us team actually is the Team Horizon. joining us. You can see the logo right here. It's the Team Evolve. That's our team. And with Aaron just explained, actually, we work together, and that's the culture of our business. It's no matter which team you are, where you are located, right? We can learn from each other. This is how we work together, learn from each other, and grow together, and also evolve together in this platform. Okay, so I think that's a great. So welcome all the new friends. Come over here, no matter you are already associates or you are quite new to what we do. So today it's one of the, I would say the main solution in the financial service industry. It's not just our company or this platform. Actually, a lot of other companies in the financial industry and Index Universal Life is one of the most important solutions in the financial services. Today, I will be the main speaker. And also, I have my business partner, the marketing director, Li Yun Li, to help me with the presentation, with the training. Actually, at the end, she will basically, she will help. If you have any questions during my presentation, you can type it in the chat, and Lily and some other managers, if you want, you can help, right, to answer those questions, right. If some questions you think is very good for everybody, right, at the end, depends on how much time we have, we can have a quick Q&A session. Okay, so Lily help me to co-host this, right? Yeah, if you have any question, you can just put over here, put over there in the chat, all right? Let me get started over here, 1 second. Aaron, you see me okay?
It is, yeah, now it's up. Okay.
Oh, yeah. I was thinking the same. It's a little bit, right now fine, right?
Yes.
Cool. Okay. Okay, so today we talk still. What's wrong?
Well, you didn't see your picture, Danny.
Is it lagging?
Your image is frozen right now, so.
I could see the screen.
Yeah, sometimes it has a problem. Let me double check. Try it again. No, it's better.
Yes.
Yes, it's up now.
Yeah, I reset. See, hopefully it's okay.
Okay, good.
Yeah, the only drawback for Zoom is the technical issue. All right, so first I want to show everybody some articles, actually some a long time ago. You see this article is back in 2010, okay, from Wall Street Journal. The article is saying the life insurance industry has enjoyed the benefit tax treatment for its product for nearly a century. Oh, actually, it's more than that. It's more than a century, right? When Congress tried to change that, insurers always have a measure at the ready. We protect the widows and orphans. Those insurance companies said, "Hey, we're doing a great thing to the government, to this country, right? So we deserve that tax treatment, right?" Another thing is the IRS loophole allows the wealthy to avoid taxes. Okay, so this is another article talk about the tax benefits in the life insurance industry. Okay, for in some cases, the client lightly pay 10 times the lowest rate, means the lowest premium for that insurance. It's weird. If people pay $10, why they pay $100, right? Because they want to save the tax for that $100. It's not a tax deductible using the pre-tax money, but the $100 grow to $200, $400, $800 without paying a dime to Uncle Sam, to IRS. Okay, so some people say there's a loophole, but it's hard to change it. There's no way to change it. Fox Business, okay, put something over here. It said they cutting out the taxman in retirement, so-called a tax-free retirement, right? The life insurance industry has the best IRS approved retirement saving plan today. And most investors know nothing about it. The retirement savings vehicle actually is IRL, right? It's not a company sponsored, pre-tax qualified like a 401k plan. It's not a Roth, and it's not annuity or it's a whole life. No. Despite sales of well over 1 billion in 2011 for the top 39 carrier survey, it's the number one secret in the industry is IUL. Well, actually, this number is already 3-4 times higher. Okay. The whole financial industry, for a lot of people, if you are already a client or you are a licensed associate already, you probably know there's 5 different kinds of life insurance over there. Besides the term, we have a whole life, universal life, variable universal life, and today the index universal life. So all the assets in all those life insurance right now is already more than $7 trillion. That's only 2018. I don't have the most recent data because those guys, they don't release the newest data, okay? But you can see the trend. If it's not 8 trillion, it's pretty close. So if you say, hey, this industry is so big and I never heard about it, then you're left behind. So it's called the cash value life insurance. It's a 7 trillion plus assets over there, right? If you compare to some other assets that we know, like the bank savings, is 14 trillion over there. And right now, the inflation is high, the interest is low, right? People are looking for a way to outperform inflation. We have the people save money in 529. That's a kids' education plan. But compared to this pie, that 529 is way too small. Am I right? Because a lot of people like my family, I save money for my kids, but I'm not using 529, which is impacting the financial way. I'm using IUL, which is not impacting my financial way. And if you look at other investments, right, the insurance industry is basically bigger than the ETF or the hedge fund. And there's a lot of books talk about the tax-free benefits in life insurance. Again, if you're like a researcher type of person, you want to read books, here are some books you can buy. Tax-free retirement, money, wealth, and life insurance, power of a zero, financial pocket knife. You read this one. It's the #1 bestseller by Jay Thompson. How the wealthy use life insurance as a tax-free personal bank. I will show you my personal bank today. Hopefully you have one for yourself and for your family, for your kid, right? Let's take a look. So the tax treatment, the benefit is something I want to point out. That will say the #1 benefit in IUL is tax treatment. First is tax deferred earning, means all the gain, you don't need to pay tax every year. There's no 1099. You don't need to pay tax. It's follow the IRC code 72. It's protected by the law. It's tax deferred earning, but can I take the earning out when I'm alive? Yes, you can. You can use a tax advantage loan. When you see tax advantage, right? Or somebody using the annotator, make fun. Yeah. Close the annotator, guys. All right. Okay. So the tax advantage loan, every time you see something called advantage, actually it's a free. It's just the Uncle Sam doesn't want the name free. People will feel like it's a trap. It's a free. No, it's tax advantage and using through a policy loan. Because loan is not equal to income, just like a HELOC, home equity line of credit. Very similar. I'll show you at the end. Okay. And if you can withdraw the money, yes, it's also tax-free cash withdrawal, tax-free withdrawal, up to the premium. It's up to the amount you put in. But if you want to use the earnings, you better use the tax advantage loan. Then you make the whole thing tax deferred and tax-free, basically. So that is 77028 law. And the tax-free transfer, what is that? For example, you have an investment portfolio, you have a mutual fund A and mutual fund B, you try to move the money from A to B, you sell the A, you buy the B, and then when you sell the A, if there's a gain, it's taxable. If you have two stocks, you have an Amazon, you have a Tesla, right? You want to sell the Tesla and buy Amazon because right now it's they changed the price, right? But when you sell the Tesla, you make a gain, you pay tax on it. So the transfer is not tax-free in normal investment. But over here in IUL, difference between different strategies is tax-free transfer, no penalty, nothing. Okay, and of course, the financial industry has been benefit the tax-free, income tax-free death benefit for more than a century. So this is very important. Okay, the tax-free gain. Let me show you the big impact of investment tax. Okay, if you have $100,000 back in 1982, that's 40 years ago. You just buy one mutual fund, S&P 500, Vanguard S&P 500. If you go up and down with the market for 40 years, no selling, no buying, and your 100,000 will compound to $8.5 million. Pretty good, right? You say, wow, that's a lot. But you look at the compounding return, it's at 11.7. But if your family income is 150,000, that's the tax. Okay, there's a dividend tax. You don't need to know about it. It's just it depends on your income. The higher the income, the higher the tax. If the household income is 150, every year the dividend you pay tax. You don't sell it, but there's a dividend tax. Then it will drag your result from 8.5 to 6 million. Oh my God, that's a 2.5 million. But you look at the return. The return, it's just about 1% down. But if you sell this $6 million, do you pay tax? Everyone would not, right? Yeah, the 6 million, there's a lot of gain right there. If you pay tax when you sell it, it will drag you down to 5 million. From 8.5 to 5 million, there's a 40% down. We call it a tax drag. Like the tax drag you down, right? Do you see that's a big deal? See, that's a big deal. But a lot of people don't pay attention to it. From the 11.7 to 10.3, it's only 1.5 points, 1.5%. But in long term, it's a 40% down. That's the huge impact of investment tax. And it's not, if you think that's it, no, it's not. Because if you have a 5 million, you want to catch up Johnny, which I have a 8.5 million, you need to grow your money 70% more. Is it easy to grow 70% more? No way, pretty hard, right? So the tax is so important. People said, well, I don't think I paid that much tax, right? My income tax is not that high. Let me show you. There's a tool actually online. If you want, I can share with everybody. The tool is provided by Nationwide. You can go to nationwide.com. You can find it. If you have $100,000 invested at 8% average return for 30 years, if your household income is a 50,000, that's it. That's 50,000 only, and 50,000 only. And the pay tax and not pay tax is 29% tax drag. 29%. If you are 150,000, that's the same as the one I show you, is a 40% tax drag. If your income is a 350, if a 2 engineer, we have a lot of Indians today, right? Are you folks IT guys? I have IT consulting. All my friends are Indian, right? And if one working for Apple, one for Google, oh my God, you're gonna pay huge, big contributor to IRS. You know what? It's a 60% tax drag. So if I say, hey, there's a one way, right away, you can save that 60%. Will you think about it? That's the big thing about tax saving. And the IUL is one of the most important tax saving vehicles out there. There's a books about it, right? So far to now, I hope you see the big impact of tax savings. Let's continue. Over here, I make the assumption it's 8%. Let's look at the return market. We all know that the last couple of months is not good for a lot of investors. Okay, the S&P 500, actually, this is the beginning of the year, right? This is the yesterday, actually. It's 18% down. It's 18% down. Your 401k, your IRA, maybe 401k becomes 301k now, right? Good job. But look at the IUL. Let me show you some example. This is my nationwide IUL, one of my example. I'll show you, this is one of the 10 policies that I have, right? And if you can see on the nationwide website, there's a lot of information there you can benefit from. They have a very good user-friendly interface right there. Okay. And over here, this IUL, I have this strategy. You can see most of this in this strategy is about $156,000 over there, right? This is my personal bank, and it's tax-free, no matter how much it grows. Okay. And right now, I changed some of my location just recently. Okay. But just look at this monthly average. Today, we are like a IUL deep dive, right? So probably on this, I will go a little bit more details. Okay, so even though you're licensed, maybe you don't know that much detail on this, right? But I want to point out the most important thing, the benefits of, today I use nationwide though, so of IUL. Let's take a look. This is the real return. This is the screenshot of my website, right? Starting the beginning of the year, this is the return of each month. Average is 8.8%. Versus the market is 18% down. And if you calculate the taxable equivalent return, what does that mean? It means if you pay tax, your investment, you're going to pay tax. For example, you buy a bond, something that gave you a gain, no market risk, but you're going to pay tax on it. Then you're going to find a place give you 11% return. Consider 20% tax rate. Can you tell me there's a place that give you 11% return and no down? No, there's no such thing. Okay. So you may ask, how is this thing calculated? Is it compounding like that? Okay, I'll show you the details. Okay. So you can see the money is allocated in 12 months. In IUL, 12 months is 12 drawers. Your saving is allocated into the 12 months. So for example, in this example, you open an account in January and every month you put $100 there, okay? So that means your $1,200 is divided into 12 months. Each month is $100, okay? So it's like a 12 separate investment right there. And on the 13th month, January, compared to the January a year ago, and the February compared to the February a year ago. Okay, if the market is up, you'll make a gain. If market is down, like index change is -10, you will get a floor of 0%. Right? In my strategy, I just show you, the floor is 0, the cap is 15. This is the old product. Okay, but right now it's changed a little bit. So if the market doing more than 15, you will get 15. So your return is nothing but between 0 and 15. You have a downside protection if the market below 0%, but you have a cap. And somebody been worried, I said, well, I understand when the market is down, I get 0, but you look at the market right here, okay? So this is the last 2 years. I use May and compared to the May of 2021, this is 2022. This is the 1 year. If you just look at the year to year, we call point to point. Hey, Johnny just mentioned The main compared to main, the market down, you should get 0, right? Why you get a 7% right there? Anyone have the question? Right? If you have the question, hopefully I can answer you here. Because in Nationwide IUL, we use something called the monthly average. What is that? That means even though it's a main to main, they use 12 months. If you look at all the dots right there, they use a 15 of each month. If you look at all the dots here, okay, the average of all the 12 dots is somewhere here, right? It's just the last month, the market dropped. And not just the last month, the last 3 months, the market dropped. But the first 8 months, the market is up. So it makes the average higher. So the monthly average is this. Then you get a positive return. That's the beauty of the monthly average. It helps you smooth out. And also in Nationwide, the monthly average is not one index, it's 3 indexes. It's NASDAQ, S&P, and Dow Jones. The best performer will get 50% weight. The second one is 30, and the last one is 20. So no matter if you don't remember that, that's totally fine. Okay? You just remember it is called a blended index. If the blended index out of the 3, blended index is negative, you will get 0. When the blended index is more than 13, you will get 13. This is the most current cap right now. If it is somewhere between 0 and 13, you will get that amount, 4.38. Okay? So this is another policy. There's another policy, and every month it shows. This is the strategy, monthly average multi-index. Okay, from March 2019 to March 2020, you know that the market crashed. The market actually is crashed like that. That's March 2020, the beginning of the pandemic. But because the monthly average, the average is up 9%. And if you compare next year, 2020 to 2021, and for this index is 10.92. Pretty good, right? Is there any place you can find a return like that with a 0% floor and this is tax-free? I do a research, actually, I updated this data every couple months. If I do a presentation, I'll update it. I track last 20 years. For the strategy with a 0% to 13%, the return average annual return is a 6.85. It's very interesting. After I do this, I said, oh my God, the S&P 500 is exactly the same. Right? It's just coincidence. Just coincidence. But you know what? Yeah. Which one you want to go? That's a tricky question, right? It really depends. Okay. If you save for long term, like a 401k, it's for retirement, right? The 401k, there's no IUL concept in 401k, but you go through the up and down. You say, I'm a 40, I'm gonna use the 401k money in 20 years. I have enough time horizon to do the risky investment. Go for it. But what if over here, in the next 5 to 10 years, I need to retire. I need to send the kids to school. I need some savings. I need the emergency fund. I don't want my emergency fund to lose value. Then which one I pick? Then I will pick IUL. So, later on, I'm going to talk about the allocation, the IUL position in the family's finance. Actually, you need both. You need the IUL to provide a safety investment to give you peace of mind. You need a 401k or stocks mutual fund to provide a higher risk and potential higher return. But don't forget, you better do state tax benefit accounts. Do not buy the mutual fund directly to pay tax. So the performance is pretty good with downside protection. And there's some very interesting thing. I said the power of a zero. You see the book right there? So I would rather use the other title is when the 12% is larger than the 20%. When did that happen? Okay, let's take a look. If you have a 50,000 assets, if this one you just dump into stock market, and for example, market crash. From the beginning of the year, there are so many stocks actually cut half. Okay, but let's say your IUL cash flow just get 0% flow when the market crash. Then you get zero. But the thing is, you don't lose anything. Look at the next year. If the next year the market bounce back 20%, your 25,000 will go back 5,000 over here. And in the IUL, you will get 12%. That's the cap. But the cap will give you $6,000. The big difference is the base is different. People don't think about it. Sometimes they say, oh, you got a stock, you get a 30% growth. Awesome. Okay, my return is only 12. Come on. Your 30% is based on what? If the 30% is based on the market crash, then you're probably still on the water. People want to talk about the percentage, but sometimes the percentage doesn't make too much sense, right? If this is the paper value, it go up and down. But this is the lock the game. Every time your game is locked, right? And here's another challenge. They said, hey, Johnny, I love the 0%. I love the power of a zero, but I just don't feel like the 12% is not enough. You told me the 13%, I feel like the cap is too low. That's the reason why there's some uncapped strategies out there. So when the market's down, you don't lose anything. That's still a 0% floor. But when the market bounces back, your return, there's no cap. But there's, I would say, a participation, or there's some discount. You cannot get, you already remove 100% of the loss. You cannot get 100%. You're going to get a portion of the gain, right? So in this case, it's your return is the index minus 7.5%. So the good thing is when the market bounces back, like, I don't know, this time compared to the beginning of the year, the market crashed already, right? I don't know when it's time to bounce back, but sooner or later, it will. People ask me, hey, how do you see the market in the next couple of months? I said, I don't know. But I know 5 years later, today is the low point. As long as I know that, I'm okay. That's the reason why I start allocating some funds into this uncapped strategy. If the market now bounce back next year, it will bounce back a year after. Okay. So we use the same method. Look at this. This is the same account. This is our cap strategy back in 2019 to 2020. Still, the market is like that. So this is the March, right? Then point to point, and that's a zero. No matter how bad the market perform, you get zero. But don't forget, the market bounced back pretty quick, right? This is 2020 and 2021. So next year, the same month, March, you get 41%. Can you find something like that? In the real investment, you get potential to get 41% up, but you get 0% protection. So what I just show you is my own accounts, actually. I just go to some statements I print out. And our allocation is the same as all the clients. So here, after the tax benefits, the second main thing I want to share with everybody is the pretty good potential and a little bit details about this market, the index strategies, okay? And our money is allocated into 12 different months and also different strategies. In this case, if you look at 2018, the market from the beginning to the end is down. If you do investments, you get negative return. But because in the IUL, your money is diversified into 12 months and using multiple strategies, then for 2018, the average return is 9.8. People say, what if every year is a zero? Forget about that assumption. That's a fake assumption. Because only when all this investment and months, everything down to zero, then the whole year is a zero. That's rarely happened. I cannot say it never happened. 2008, it happened once. But that's it. That's the only once. All the strategy, 0 for 12 months. Right? So you don't need to worry about there's a 0. You don't need to worry about this month, but like the coming months, maybe we're going to have some zeros. But when the market bounces back, we're going to have a lot. When people lose money, when the market down, you don't lose anything. You're already making money. So besides the tax benefit, the great growth potential and flexibility of choice, that's so important. So far, so good. I think so far my speed is good. Yeah. And let's look at the IUL benefit as a whole. Okay. The flexible funding, you can put more or less. I don't talk too much on that. Let's skip that. But I'm mainly focused on the tax-free growth and the tax-free access, right? And I just talked about the 0% downside protection just now. So those are something I just emphasize, right? So if you have young kids, you plan to save money for the kids go to college. At the age of 16, 17, 18, 19, 20, 21, 22, oh my God, how many years right there? If they go to graduate school, that's longer, right? Who knows how the market will perform during those days? If the market crash, you cannot say, hey, son, I'm sorry, because market crash. You have to delay your college. How about that? There's no way you can do that, right? So you want to save that money into a safety place, but also give you tax benefit and no impact to financial aid, and you can also access it. That's the IUL I'm talking about. But all those tax benefits and the game and everything in this money back, right? It's not given to you for free. You have to associate with a life insurance because the tax benefit is associated with the insurance industry. But nowadays, the life insurance has been evolved so much. It's not just the death benefit anymore. A lot of people use that for living benefits like a critical illness or long-term care. They don't want to give burden to their kids. No matter they're young or they're old. I have a lot of a single person, they get IUL. I have a lot of people, they never married, they never have, they married, they never have a kids, they don't want to have a kids, but they're going to take care of themselves, right? And then they set the beneficiary to their church. So awesome. So if you combine these two, you have a great protection, no matter you're live or not, right? Living benefits or death benefit, and you have a great growth on the a cash value saving, or we call it tax-free cash build up. Okay. So that's very important. For a lot of people, they are working for a company, they have a health insurance, term life, disability insurance, but I would say I don't see any employer provide critical illness protection and permanent life insurance. No, they're always term and no critical illness. And so what is critical illness? For example, if I diagnose COVID and for the early age, I went to ACU, that's pretty bad, right? Right now it's fine, just like a cough, it's just like getting cold. But people getting to ICU, that's a big deal. That's a critical illness. All the expenses will cover by health insurance, but your health insurance will never pay your mortgage. But the critical illness will pay you a lump sum and you can pay off your mortgage. That's critical illness protection. And long-term care, Washington State is about to start a long-term care tax. For everybody you're making money, you have to pay a tax. It's basically 0.58%, unless you have a long-term care protection yourself already, you buy in the market. I look at the government plan, it's so bad. That's the reason why a lot of people are going to shop around for the long-term care solution. Guess which state is the next one going to start the long-term care tax? Aaron, do you know?
California.
Thank you, Roger. California this year. They're going to start talking about it. Oh my God, I'm in California. So, and even though you look at the government-sponsored long-term care, something, oh my God, this is so bad. It's not good at all, right? Just like a social security is a social security. Some people say, can I not pay that? And you don't pay the social security income when I retire. If you allow me to not pay the social security now, it's not good. Okay, whatever. So family protection is important. No matter long-term care or critical or permanent life insurance, just remember that the younger, the cheaper. So that's the reason why when I was 27, I was not married, I have no kid, I have no house, I have no liability, but I still get IUL because I know two things. Number one, save tax as early as possible because that thing can compound. Number two, I'm young, I'm cheaper, insurance point of view. So there's no point you don't want to start. But how much? Sometimes I see people have insurance, IUL insurance with a 300,000 face amount, means the umbrella size. Actually, it depends on the finance, but it's not too much. It's not considered too much. In the industry, the face amount is more than 3 million. That's considered a big amount. The underwriting process will be different. And just yesterday, I met not my client though, but he opened a $4 million IUL. And then later he asked me, he said, can I lower it down? Because I feel like I didn't need that much. So I do some analysis with him. I say, yeah, actually you don't need that much. Why you buy so much? Right? He said, well, the agent just tell me the importance of long-term care, critical illness. I said, well, yes, it is important, but it also need to be suitable and affordable, right? So the position of the IUL is so important. This is the chart. If you look at the right, more money to the right will give you more opportunity, but less safety. For example, a mutual fund and stock, like 401k right here. You're gonna manage the money. You don't want to look at it 401k today, right? Close your account. Don't look at it, right? From January to right now, not good. Do not sell it, right? As a financial advisor, one main job is to prevent people to make rational decisions when they're emotional low, right? Don't sell it. Don't realize the loss. Okay, market will bounce back, but I don't know when. Let's see. Hopefully later this year. And on the left-hand side, you will see it's more safety, but less opportunity, means less growth. For example, money in the bank. I want to give everybody my definition of safety. Okay. If the inflation is 8% right now, crazy high, hopefully the Fed can lower it down to about 4 and 3 around that, because right now they're increasing the interest rate right now, the prime rate, right? Because try to cool down the inflation. Too high inflation will drive people crazy with the uncertainty, will make the market really volatile. So it's not good. But look at that. Money in the bank give you 1%, inflation is 8%, right? So anything cannot outperform inflation, I will consider just saving money, not making money or grow your money. It's not safe at all. It's a guarantee lose purchasing power. Am I right? So how can you say this is safe if it cannot keep up with inflation? So if I talk about investment, any investment has to outperform inflation. So that's why I say IUL is a investment. It's a safety investment. VUL, it's a risky investment, just like stocks and mutual funds. But whole life is not an investment. It's a saving. It's better than a bank, whole life policy. Or money in the bank, it's a saving. It's not investment. You cannot say that's a safety investment. That's a safety net for your money. That's it. But not an investment. But as a financial advisor, we help family to identify investment, allocate investment in order to get good return, am I right? That's what we do. So position the IUL wisely and allocate suitable and affordable. Let me show you another account. That's my wife's account. It starts in 2009. 2009, if you know my story, 2009, actually I got laid off from my IT consulting work. Okay, I was an Oracle IT consultant. Company say here, right? I was an IT consultant. And we just married, and my wife just moved from China to US. She worked for Nokia at the time. And if I still in IT, then we're gonna make double six-figure income. But I was laid off, and my business is just picking up at the time, making not much. And so the family has to depend on my wife's income, not too much though. Okay. But we know the tax savings as early as possible, the insurance protection is as early as possible. So even though we don't have much money, we still set aside $400 a month to start this vehicle. This is the IUL, her IUL, a $500,000 policy. So you can see the column D is the funding. The first year is not too much. It's not even higher than a Roth IRA, right? But the good thing is, for IRA or Roth IRA or 401k or Roth 401k, if you miss the funding, you cannot catch up later. For example, IRA, you have a $6,000. If you put $3,000 this year, next year, you lose another 3,000 quota right there. Next year, the maximum is still 6,000. But for IUL, if you put less this year, you still keep the capacity. So later on, just like the third and fourth, if I have a more income, I can catch up the funding. So that's a pretty good to me. That's the reason why I opened multiple accounts, because I know my business is gonna go up, I'm gonna have more income, right? And I need a place to put my money to save tax. I hope that makes sense to you. Okay. But a lot of people I said, okay, Johnny, you talk about a lot of the good things about IUL. What's the other side? Okay. Oh, I heard that the cost is so high. Let's take a look. The column E is cost. The column F is gain. Okay. The column H is the percentage. Quickly, you see the percentage over here. This is the real percentage. There's no year is a zero because it's diversified in 12 months and it's diversified in multiple strategies. The first year, cost is higher. Gain is less. Second year, still cost is higher. The third year, the fourth year, look at the fourth year. Starting the fourth year, the gain is higher. And then all the years, the gain is higher. So actually, for people who said the cost is higher, actually it's only the first 3 years, right? Can you live more than 3 years? Oh yeah, actually it's a wrong question, right? If I die within the 3 years, my beneficiary will get a lot of money. This is insurance, right? But if I can live more than 3 years, this is a pretty good saving account, safety investment for me, because my gain can cover the cost. And it's growth tax free. So that's how I do a client review. If some licensed associate online, if you want to do a client review, this is a very good way. And I show your client the potential, and you all know that the cost of insurance will drop after the 10th year. So it really looks like this. The annual cost is right here. Actually, the first few years is high, but for the rest of the years, the cost is low and the gain is much higher. And don't forget, all the gain is tax-free. So some people say that this IUL cost is higher because they're short-sighted. If you are a little bit longer thinking, you will understand how it works. Let me show you a real example. Okay, I just run this today. This is based on the illustration of softwares. Anyone run nationwide illustration gonna see this. It's a 35-year-old male, $500,000 face amount with a normal funding. What is normal funding? You know the minimum funding is target premium, 5,000 something for 15 years. The maximum funding is a 31,000 for 3 years, right? But I'm now using 5,000 that less and 31,000 that much. I'm only using $1,000 a month. So it's a 12,000 a year, normal funding. Let's take a look. We gotta understand, today is a deep dive. So normally for pure client, we don't talk too much about the detailed cost. But you guys in the treat right now today, I wanna show you, actually it's not that hard, it's pretty simple, you know? There's a charge and there's a cost of insurance. So there's two charges. Number one is called premium charge. It's only related to the new premium. When you pay no premium, then there's no charge. right? So you see, I stopped the funding at the age of 44, then there's no charge. So if you're good at math, you call it linear. It's not compounding. It's only charged on the new money, not the existing money. So another charge is the policy management fee. The industry standard is $120 a year. That's it, not too much. $120 a year. And there's a two costs of insurance. One is called per thousand base, called PUC, per thousand base, or called per unit charge. 1,000 is a 1 unit per unit charge, PUC. Okay, so I explained that to like fixed insurance cost only the first 10 years, and then it dropped to 0. And then the cost of insurance is this one, the variable insurance cost. It calculated by unit price times units. Today, we don't have too much time to talk about these details, but in the nationwide illustration, there's a page called monthly unit price. You can get the unit price right here, and then you can times the unit. What is a unit? 1,000 insurance is equal to 1 unit. Okay, and the more cash value you build up, the less unit you're buying, because you're self-insured, right? You buy $500,000 policy, you already save 300,000 there. Then the insurance company only risk is the rest, the 200,000. So the unit is no longer 500 when you start, it dropped to 200 units because you already contribute the cash value a lot. Right here, for example, the policy value is 200,000, then the unit is dropped to 300. If you don't know what it is, it's a little bit too detailed. You can talk to your managers and go over that. But the good things about the IUL is all the cost is very transparent. Okay. Let's look at this here. Let me ask you a question. The investment gain is based on 5.74% calculated. When I show you the historical is basically more around 7%, right? I show you several examples already. So over here, the $6,000, the gain over here is tax-free. And the cost of insurance is $300. Let me ask you a question. Will you pay the tax on the gain outside or save the tax here inside, but you have to pay $300 cost of insurance? Which one you want to pay? How much tax you save? I would say probably $2,000. Will you pay $2,000 outside, or you're gonna pay $300 inside? I will pay $300. How about you? That's a very simple, I think, because it's very transparent. Look at this here. Do you want to pay a couple $1,000 tax for the 10,000 gain outside, or you want to save the tax and only pay $752 inside in cost of insurance? And the cost of insurance is not just cost. You also exchange insurance, right? And long-term care and critical illness and benefits right there, living benefits there, right? So, and it's not finished yet. You think that's finished? Not yet. Nationwide is pretty generous. It's a nationwide IUL accumulator has a loyalty bonus starting year 16 to cover a portion of your cost of insurance. Think about that. No matter, even though there's 1 year get zero here, but this will give you $399 to cover almost half of your costs already. Why you're so worried? Right? For the people who have a long-term care, this is a long-term care right now. I didn't get it. If I put a long-term care here, I think highly likely it's less than this amount. The loyalty bonus can cover the long-term care rider for you. Then you can qualify the state requirement. Then you don't pay the long-term care tax. That program sucks, right? So this is our solution.
Just curious, Johnny, that other company also offer this conditional credit, like Transamerica?
No, like Transamerica doesn't have. Nationwide has. Some other company has, right? But Transamerica has a very good cap, right? The higher cap. So yeah, every company have their pros and cons actually. Okay, that's a detail. But overall, the overall concept, what does it show is what? The tax savings, no matter which IUL, which company, is much higher than the cost. So why are you worried, right? You're gonna pay cost anyway. You pay car insurance cost, the property tax, all different kinds of taxes right there, right? Yeah. So compare the benefit and the cost. All right, so I just point out some basic important things. As a family foundation, in summary, we help a family to build a financial foundation. IUL can help us in many ways. For example, it's the family protection. You know, the IUL actually here is part of the investment. It's part of the investment. It's the safety investment. Since I can use the money, it's part of the emergency fund. And it also provides life insurance, long-term care, and critical illness protections. If you want, you can use the money in IUL, right, to put into the risky investment if you think the timing is proper. So let's look at the A need. We always talk about that. Today I focus on the IUL because it's a Swiss Army knife in financial service industry. When you look at a family's financial need, people have emergency fund, mortgage, investment, tax, education for kids, retirement saving for ourselves, protections, and estate planning. This is the 8 big needs for family finance. We can talk. Each one is topic that talk hours of it. But you know what? Why we focus on the IUL today? Because look at this. IUL can help provide a protection and estate planning with a bigger umbrella and small savings. It's called an insurance. It's leveraging, right? You use small money to exchange a big money to pass on assets. But you can use IUL for retirements, educations, and tax-free investments, and also provide an emergency fund for the bank. But the design needs to be, I want to put more money and keep the insurance a little bit smaller so I can maximize the saving. That's a different design or understanding of insurance. I'm using it as a living benefit, not as a death benefit. This is a death benefit, right? But no matter what, all this design you can do, right? I started a business in 2007, January. I have my first VUL in 2007, and the one I showed you, my wife, is the 2009 IUL. Okay. And then when my boy is born, right? A lot of people are celebrating and all the things. So I opened the IUL besides the party. Besides the party, okay. Also have kid, have an IUL too, right? So I'm the main breadwinner. So I have a critical illness protection. I have a long-term care protection. I have a safety investment. I have a risky investment. My wife is pretty conservative. All IULs. My son is IUL and VUL. So right now, I have a total 10 million plus of family protection. I think it's good enough. You know, if I pass away or I'm still alive, right? And the most importantly, I have a $1 million plus personal bank, tax-free. That's a big deal. At 10 years ago, I listened to one of the co-founders said, we are here to help people to become cash millionaire. At the beginning, I didn't understand. I feel like it's the cash in the bank, right? I confused. And it said, if the investment cannot outperform inflation, it's not considered investment. So the cash millionaire is the investment, and it's a personal bank, means it has a protections to it, right? Since it's a personal bank, you're gonna access it, right? So the last thing is how the loan work, right? I don't want to spend too much time on it. I just quickly show you, right? If you are here, you want to access your money, the first step is, hey, Nationwide, I need my money. How much? Okay, 30,000. All right. So Nationwide will give you 30,000. This is called the loan amount or loan balance. And then Nationwide will, from your account, will say, hey, I'm going to put a 30,000, move 30,000 from your account into Nationwide. This is called loan reserve. Okay? And since this is a loan not equal to income, there's no tax to it. But since there's a loan, it's associated with the interest then, right? So let's say the interest is 3%. okay, the loan balance is 3% if you don't pay back. All right? So, but the loan reserve is basically considered nationwide borrow money from your account. So it's also borrow money. So this loan reserve, that's your money, is also grows 3%. So which means a year later, you own the company 30,000 plus 3%, but the company also own you 3% your account. So that's basically the same. If you pay back 30K plus $900, that's a 3%, right? So all the money will pay back to your account. Your account will grow 300,000 and also grow $900 because the 3% will go back to your own account. But within the first 10 years, this a little bit higher, right? It's a 3.9, so this is a $990 interest. If you pay back, the $900 will go back to your account, and the insurance company will basically keep the $90, which is the 0.9%. This is the cost of the loan. I get the loan in 1 day. I requested 22, I got it in 20 seconds. And I pay back the loan, right? And this is a Transmarca one. Transmarca is a 3.75. So after I paid it off, everything clear, then it calculates, okay, the interest you owe me, insurance company, is a $1,700, but I will pay the $1,300 back to your account. That's how the loan works. There's no tax associated to it. Okay. So over here, I want to pass to Lily. We prepared 2 testimony for you guys about how the IUL position in their family and how they use it. So I think that will be very helpful, right? Lily, you there?
Thank you. Thank you, Johnny. Good evening, everyone. My name is Lily Ning. My SMD is Johnny Q and Lilian. It's my pleasure to host this testimony today. I believe we don't have too much time here, so I will do a little bit faster this case. I believe after Johnny's deep dive, you all know that IUL is not only a family protection for us, it's also our lifetime tax-free, risk-free investment vehicle, right? So I believe after so many of us going through this deep dive, you probably want more for yourself or for your family, or we want to go outside to educate more people, right? Now, I'm going to invite 2 managers to share with us how the family, how their clients benefit from this IUL particularly. The first one is Lilian Lee. She is the better half of our Johnny Q. Lilian, are you there?
Yes, can you hear me?
Yes, I can hear you.
Yes. Hello, everyone. It's my pleasure to share with you my family experience. This is about how the flexible IUL is. In 2020 summer, it's the beginning of the pandemic. My in-laws, they were applying for a green card for them, and they get stuck here because of the pandemic. Since they almost got a green card, so they're thinking about they want to move to the US, so they need a house. So we help them to starting looking for the house for them. But where is the down payment? They want to buy a single family, more than $1 million. Where is the down payment? I think any family for $250,000 saving in the bank is rare, right? Normally our emergency fund maximum like 100,000. So I'm glad that we have several IULs that we opened in the past, and now it's very flexible to access the money. So we called different insurance companies, and we have the policy loan to loan out money as the down payment for their house. Within a week, we got a bank transfer already. Very convenient, and the interest is also low since we own the policy for a while. So I want to say IUL is really very flexible as the personal saving account since we own it for quite a while. And not only very flexible, it's a safe investment. I know other people, they save their down payment in the stock account, but the stock up and down, and sometimes people lose money in the stock market and they lose their down payment. But in IUL, we're not losing money. The worst case is 0%. So we feel safe that anytime we need money, we can borrow from the IUL account. Also, well, when we need it, when we don't need it, it's gaining for itself. It's earning interest for a long time until we need it. So if we don't need it right now, then we'll save it for retirement. So it's a long-term saving, much better than the bank. We do have emergency fund in the bank, but only not that much needed in the bank. For the rest saving, we save a lot in the IUL because it's growing like 8 to 9% in the past years. So I think it's less return from the stock market, but much better than bank and bond. Also very flexible, not like a stock market. When you need the money, the market is down, then you don't want to take the loss. That's my sharing. I really appreciate we made the right decision to own the product, and several years later, it's very easy to access. By the way, we already loan out and then we put the money back, so it's back to the original. So yeah, thank you. That's my sharing.
Thank you, Lilia. I think that's a benefit, both benefit, right? Doing business and getting all these benefit from learning our own product, right? Now, may I please have another senior marketing director, Pepe Shen. Pepe Shen has been in the business for over 15 years. She is one of the best manager I really like, I admire, and she's located in San Diego. Okay, can we have Pepe Shen? Thank you.
Okay, thank you, Lily. So I hope I'm in this business for over 15 years, but actually, it's not less, it's less than 15 years. I can have a lot of story I can tell. So why do I think IUL is a very important saving vehicle for family? Do you think because I've been in the field for over 12 years? So my personal experience and my clients' experience, yes, I would say, those experiences help me. And I have many story I can tell, but I don't have much time. So I will share with you my personal story. So back to 2000, when I got pregnant, and so I know my boy is going to be delivered in 2001. So I was thinking about how to save money for my kids' college tuition. And at that time, my husband and I, we did investment in stocks because we like stock investment, give you potential, and we really made some money. But 2000, since 2000, and you know about we call IT dot, right? .com and bubbles. So this is why I'm thinking, I should find some vehicle is good for my family. And a friend of mine was working at an insurance company at that time, and she suggested me. So she said, you know what? Why don't I present mutual fund based life insurance? And so because my husband and I, so we set an appointment. And so after she looked at our life insurance, because we don't have life insurance at that time, my husband had term. So this is why my husband did not have enough coverage, and we also need to save for our son's education. Then we bought variable universal life. So it's mutual fund investment. But unfortunately, everybody knows, right? Everybody knows since 2002, the market has continued to fall, and the value of VUL, and has fallen with it. So we are not happy with the performance. And also look at our investment in IRAs and stocks. So at that time, we didn't think that it was safe to save money, in VUL. So what did I do? I don't know what you will do, but I called the insurance company and I say, hey, please reduce the payment. And I saw VUL, as just an insurance tool. But until 2008, I met Sunny Huang. So right now she is a SEVC. So then I met Johnny. To me, to my family, this was a turning point, especially our family asset allocation. So with Sunny Education and with learning from this platform, from Johnny, from other leaders, great leaders, and then I realized that my assets, my family assets we used to have, actually is more in risk investment. I would say probably 90%, except the house, right? So most of our assets, were risky investment. And at that time, we did not pay attention to tax impact on our investment, and also what kind of tax benefit we could have. I have a accounting background, and I used to work, as a CPA firm, and also I love tax. But you know what? Tell you the truth, not all CPAs understand the tax implication of every asset in finance, and they did not even know how does it work. So like me, I did not know either until I saw the chart. Johnny just share with you. The big difference: 100,000 K, with tax benefit, without tax benefit, almost 3 million, right? 3 to 4 million. So this give me impact. I say, wow, a first 10 years, no difference. So then I think I earned gain, short-term, long-term capital gain, because I did not know, the impact. And then there's something coming up in my mind, because I want to save money for my kids' college. So if right now my son is 20, so he went to college in 2019. And so I have to make sure, we have save money, save investment to cover my kids' college expenses. So you know what? Then, because I came into this field and I learned, and even not VUL, but also I learned IUL, Index Universal Life. So gradually, I understand this is a safety investment. So then I start to have, safety investment. My husband and I, and also my kids, we purchased the Index Universal Life insurance. So you know what? My son went to college in 2019, I just mentioned. And in March 2020, what happened? The market fell due to the pandemic, right? And my kids going to the college in 2019. So no one has a crystal ball, right? Even I have money in VUL, but I don't want to use it, because once I use it, market went down and then I lose money. So, but because I have IUL index universal life, and I have money in index universal life. So I was not worried about at all because I knew I had savings in IUL. And so I could withdraw money anytime. And do you think it's very important when you need money and you don't have to worry about the market? I admit I'm a risk taker. But when this happened, when I want to use money, I don't want to lose money. I don't want to lose money in the market when market went down and I took money out. But IUL can help you, can do it for you. So this is why I think that for each family, so they should have a safety investment and risk investment. So as long as you need money, then you can get it. And so with loan, so it's tax free, right? And then you don't have to pay back, or you want to pay back, it's okay. So you get money so quickly. So this is why I like IUL. I love IUL. So this is why I encourage my clients. I share with them my story, and also not impact the financial aid. So why not? So many benefits. So IUL is the missing part for each family. So this is what I want to share with you. So hope will help you. Thank you.
Thank you, Pepe. That's a great sharing. Thank you for sharing here. Now, let me return back to Aaron. Thank you.
All right. Well, thank you, Lily. And thank you, Lillian and Pepe, and especially Johnny. Wasn't tonight's topic informative? I personally learned a lot, such as Johnny's up-to-the-minute reporting of the market risks and his detailed explanations of monthly average and multi-index investment strategies. These are concepts and details that we can put to use in explaining to other people how these products work. So it's very informative for that reason. And actually, we have a training system that guides you from A to Z in order for you to reach your financial goals and potentially build up a business income pipeline. Every month, we have a series of trainings and meetings. Tonight was a product night training. And because the contents are very useful and insightful, our leadership team decided to open this training to new friends who are not associates yet. In other trainings, we also have topics about the financial industry and how to build a business in finance. Now, lastly, I want to ask if you have read this book. Sorry, just a moment.
Yeah, you can go ahead, share the screen.
Yeah, there we are. All right. So I would like to ask if you have read this book, Lower Your Taxes Big Time, by Sandy Botkin, who is a CPA and a former IRS attorney. He states that if we don't have a business, we are practically brain dead. After you filed your income tax for last year, did you get a refund? Would you like to have a refund this year? So if so, you need to have a business. When you eat out with your friends, you can claim that as a business expense because you talk about education or retirement planning. When you travel to another state, you can claim that as a business expense too, because you go to see a friend or a client and talk about business. When you have a party at home, you may also claim that as a business expense. This is how rich people are taking advantage of this. So why not the rest of us? Business is the answer. I would recommend our new guests sit down with our licensed associates or the person who invited you to this meeting and get to know more. Now, we would like to ask you to please take a moment and help us by giving your feedback on a poll. Woo.